In this video, we're going to talk about disposal. We've been going through our example with this asset, our forklift. And we started off by saying that it had a cost of $16,700. So on our balance sheet, we should have equipment with a value of $16,700. Then we depreciated or expensed the equipment over the life that was useful to us. So we subtracted the accumulated depreciation, which in total was $15,000. Because the equipment, net of the depreciation, at the end of the 5 years, which was 2029, had a value of $1,700. At least that's what we estimated. And this, again, is what we refer to as the residual value. Now, the residual value is what we think it is worth when we will be done with it. Now, we have to estimate this because we can't tell the future. In 2025, when we bought the equipment, we paid $16,700 and capitalized that amount of cost related to this asset. But in 2025, we don't know for certain what the asset will be worth in 2029. And so we estimate. And we estimated that it would be worth $1,700. Now, let's assume that we're done with it and we're ready to sell it. And we get an offer. Somebody offers us. We get an offer for $1,500. We'll just make it easy. $1,500. Somebody is willing to pay us $1,500 for the asset, and we accept. Okay, we accept an offer for $1,500. What do we record? So here's our journal. We'll use this journal to account for these transactions. What do I do? Let's say that this is January 1st of 2020. We're done in 2029, we sell in 2020. What do we do? Well, we know we're going to record a debit to cash for $1,500 because somebody paid us $1,500 for our equipment. Then I don't have the equipment anymore, so I can credit my equipment account for $16,700 so that account is zeroed out in terms of this asset. And if I get rid of the equipment, I also no longer need the accumulated depreciation account that goes with that equipment. So $15,000. Now, accumulated depreciation, again, is a contra asset, normally has a credit balance. So if I'm going to get rid of it, I have to debit that account. But if I look at this now, I'm not done. And I can tell I'm not done because I have $16,700 in credits, and I only have $16,500 in debits. So I'm missing a $200 debit to make this balance, right? What do I do here? What do I put here? What account do I use? Well, let's take a look at the equation for this company. Maybe we can figure it out. The equation for our company here assets, liabilities, and equity. What's happening? Well, my assets are going up by $1,500 because I'm getting cash. My assets are going down by $16,700 because I removed the equipment. And my assets go up by $15,000 because I removed the contra asset. So overall, what is the change? What is the change here? I have a net decrease of $200. So if my the asset side of my equation goes down by 200. What has to happen to the other side of my equation? Well, it also has to go down by 200. All right, well, is this a reduction of my liabilities? I don't owe anybody money here, so that's not it. Which means it has to be a reduction in my equity. All right, well, what's an equity? Well, we have common stock. Is my stock changing because of this? Well, no, that's not it. And we have retained earnings. Well, this must be a reduction in my retained earnings. So what do I do? Well, is it a reduction of revenue? Well, no. Is this an expense? Maybe. We'll come back to that. Is it a dividend? Well, no, that's not it. So it could be an expense, but what are expenses? Expenses are costs we incur to generate revenue. Is this a cost I'm incurring to generate revenue? Well, no, it's not. So that's not it. So I don't know what it is. At this point in our course, at this point in the videos, we don't know what this is. What we don't know is that there are two other kinds of accounts that exist. We have gains and losses. In this case, we have a loss. We have a $200 loss. And so in our transaction, we would record a loss on disposal. Gains and losses. So let's take a minute to define these. What are gains and losses? These are increases or decreases, depending if it's a gain or a loss, in our assets due to non-operating activities. Increases or decreases in our assets due to non-operating activities. Here we have a non-operating activity. We sold a piece of equipment. That is not our daily operation, right? This is something we don't do on a daily basis. It is selling a long-term asset. And so we have a investing activity. Investing activities are selling or purchasing long-term assets. And we have increases or decreases to our assets as a result of those. And so we have a loss here on disposal, okay, because our assets decreased. What happens if we accepted an offer for $2,000? Well, what would happen then? Well, if we accepted an offer for $2,000, see if I can cut this off here. We would get cash of $2,000. We would get rid of the equipment of $16,700. We would get rid of the accumulated depreciation of $15,000. So we have $17,000 on the debit side and $16,700 on the credit side. We're missing a $300 credit, which would be a gain on disposal. And so when we dispose of equipment, we will recognize, in all likelihood, a gain or a loss on that disposal, because our assets are either going to increase as a result of the disposal or they're going to decrease. Now, what would happen if we got an offer for $1,700? Well, then it would be fairly simple, right? We would get cash of $1,700. We would get rid of accumulated depreciation of $15,000. And we would record the equipment leaving of $16,700, right? There would not be a gain or a loss. But that's only going to happen if our estimate, right, was correct in the first place.